Hi, I'm Mike.
I'm Megan, and in this video, we'll be talking about what impacts bond returns.
Most of you may know, bonds offer a coupon, otherwise known as interest payments. This is to compensate investors for the risk they are taking with the investment. For example, if a bond is issued at a 5% coupon, investors can expect to make 5% per year in interest payments. Easy. We can end the video now, right?
Not so fast. Remember, total return is what an investor makes through any interest received plus whatever happens with the investment's price. If the bond appreciates in value, that will add to the total return and vice versa. Bond prices go up and down like stock prices do.
Right, I remember how bonds work now. Let's unpack things a little bit. It's important to remember that unlike stocks, which are solely issued by companies, bonds are issued by both companies and governments looking to borrow money from investors for various reasons. For example, a company may need money to build a new factory, and a government may need money to build a school.
Bonds issued by federal governments in developed countries, like Canada and the US, are generally considered low-risk investments because they're backed by the full faith of the issuing government. These bonds are considered to be among the safest in the world.
Really safe.
Anyways, this is because these governments are so likely to make the payments they owe on time.
On the other hand, bonds issued by companies, generally referred to as corporate bonds, are often considered relatively riskier because the company may not be able to afford to repay what they borrowed initially, or they may miss a coupon payment along the way. Missing a payment or failing to repay the bond is called a default.
Now that we got that out of the way, in order to understand what influences a bond's price, you need to understand the types of risks that you're taking when you make these investments. While there are various risks to consider, the two primary ones that typically influence a bond's price are interest rate risk and credit risk.
Let's start with interest rate risk. As a general rule of thumb, if interest rates move up, bond prices go down. And if interest rates move down, bond prices go up.
Why is that? Well, let's take a look at an example. If you buy a government bond offering a 3% coupon for $100 and interest rates rise to 4%, does that mean your bond is now less valuable with the newer bonds being sold in the market offering a higher coupon?
Exactly, Megan. Your bond is immediately less valuable. No one would pay $100 for your bond when they can get a higher coupon elsewhere for the same amount of money. Therefore, the price of your bond would need to go down to make someone indifferent between buying the two.
Makes sense. Most bonds will have some degree of interest rate risk, but they're not all created equal. We use a term called duration to give us an idea for how sensitive a bond's price is to changes in the interest rates. The higher the duration, the higher the price sensitivity to changes in interest rates.
Now let's think about credit risk. We mentioned earlier that buying a bond from a company is generally riskier than investing in the government. So let's discuss that in greater detail.
If a government is offering a 10-year bond with a coupon of 3%, any company that also wants to offer a 10-year bond will need to do so at a coupon higher than 3% because an investor will need to be compensated for the additional risk they're taking.
Let's say they offer a coupon of 5%. The additional 2% they are making on the bond is called the credit spread.
Like interest rates, credit spreads can also fluctuate for plenty of reasons, and they impact a bond's price the same way. A major reason why credit spreads adjust is due to changes in a company's fundamentals.
For example, let's say you bought a corporate bond in 2018 for $100, and then COVID happened in early 2020. Well, many companies had to close their doors while we were in lockdown during the pandemic.
Since this company would be making less money, they would also be more likely to miss a coupon payment, since they have less cash available. The credit spread would therefore need to adjust or widen to compensate investors for the new risk.
Using the earlier example, maybe the credit spread widens from 2% to 3%, resulting in the overall yield to go from 5% to 6%. This will have the same impact to the bond's price as if interest rates moved up 1%.
The opposite can also happen. If the company increases creditworthiness, the spread will instead narrow. All this to say, widening credit spreads are negative to bond prices and narrowing credit spreads are positive to bond prices.
Who determines this creditworthiness of companies? Well, luckily for us, there are people with full-time jobs for that. Assigned credit ratings is primarily done by bond rating agencies.
bond rating agencies assess the creditworthiness of bond issuers and give them a public score. An issuer with a low probability of default, like the Government of Canada, will receive a high rating, like AAA. An issuer that is less financially healthy and therefore more likely to default may be given a rating of B.
Think of movie critics as being like the bond rating agencies. They evaluate movies and provide a rating to let the public know whether or not it's a good movie. Much like the bond rating agencies, we use and trust them to provide a rating in order for us to formulate an opinion.
These bond ratings are important since entities that are lower in credit quality need to offer wider credit spreads and therefore higher interest rates to compensate investors for the additional risk in comparison to a higher quality issuer.
The higher the risk, the higher the reward. Just be wary of taking on too much risk. Remember, if a bond defaults, you are at risk of not recovering your initial investment.
Hopefully this video has been another helpful step for you in your education on investments.
Remember, bond prices can fluctuate with changes in interest rates or changes in creditworthiness of the issuer. So it's important to consider bonds that are aligned with your risk tolerance.
Thanks for joining us today. Make sure to continue following along with our videos to learn more about investing. Have a great day.